Good morning, everyone, and welcome to a Canadian Lenders Association event on how to build a resilient collection strategy. Before we get started, we want to thank our sponsor, Lexop, for supporting this event and supporting fintech lenders in Canada and fintech lending innovation in Canada. A few quick notes before we get started. If you don't already know, the Canadian Lenders Association is the largest trade group for commercial and consumer lending in the country. We have almost 100 members from coast to coast. We run events like this fairly often, about once a month. So if you're interested in joining us for another webinar, or sponsoring or participating, please go to lendersevents.com. And at the end of the session, we'll be sending out a recording, so if you missed parts of it, don't worry. And with that, I'm going to hand things over to your moderator, James, to get you started.
Very good. Thanks, Dal. And yeah, thanks also to the Canadian Lenders Association for reaching out and giving an opportunity to moderate. I'm looking forward to today's discussion. We have an excellent panel, everybody from Montreal, Toronto, Mississauga, out to Vancouver. I'm here in gloomy Saskatchewan right now. So welcome. I just want to first take a few moments just to introduce our panelists, and we'll get right into it. There is an opportunity, and I would just ask them, just hearing some feedback already, if everybody can just put their that goes with the speakers too, just on mute, and then we'll that way we don't get the feedback, and our ears will all be fine. So yeah, I just wanted to introduce some of our panelists, and just wanted to give them thanks. I will start with Amir Tashkarimi from Lexop, one of the sponsors for today. Amir is a CEO and co-founder of Lexop, which is a fast-growing fintech startup that's leading a change within the collections industry and impacting thousands daily. Prior to that, Amir practiced banking and IT law for many firms such as IMK, BCF, and Heaton Blakely, and then with the National Bank of Canada. And he's published author and has contributed to the Doing Business report presented by the World Bank Group. And Amir joins us, I assume, from Montreal. Then next panelist, we have Brian Semigné. I think I got that right, just in terms of pronunciation. And Brian is the president of County Seat Financial Group, which is a leading full-service partner and provider of purchasing and serving solutions for institutions managing receivables in Canada. County Seat works directly with institutions to provide efficient access to capital, and improving operational expense structure and utilizing technology-enabled operations, providing businesses with flexibility across the credit spectrum to acquire all segments in the consumer receivables market. And then next, bright and early, out in Vancouver is Nathan Slee, and he is the CEO of Progressa, which is one of Canada's fastest growing financial technology lenders, focused on changing the way paycheck to paycheck Canadians access and build credit. Progressa provides itself in being a socially responsible consumer finance company, whilst empowering collection agencies and enterprises to offer proactive solutions and drive healthy recoveries while protecting brand reputation with industry-leading NSPs and servicing. And Progressa was also one of the sponsors of the 2019 Canadian Lenders Summit. And then last but not least, we have Clinton Hosanna, and we want to give a big shout out to Clinton. Just actually found out this morning, one of our other panelists unfortunately couldn't make it, Robert Anzini, and I did have a write-up for him, so won't have as much to say, but I do want to thank Clinton for joining us. He is VP Operations over at LM Credit, which is the sister company of LM Financial, and it's a loan company specializing in elevating credit, and he's joining us from Mississauga. So just prior to the introductions, I did want to mention we are encouraging an open dialogue and questions. You'll see just in the bottom of your screen, there's two little bubbles that says Q&A. We were going to offer an opportunity for questions at the end, but just in terms of the format, I think it'd actually be a lot better if there's any particular item that some of our panelists are talking to or any burning questions. We'll just answer them live, enter them in, I'll read them out, and then just leave it to the panel to discuss. So yeah, the topic of today's conversation is how to build a resilient collection strategy, and that's in the backdrop of COVID, one of the deepest recessions probably since the 1920s, and so many fintechs have raised massive amounts of capital within that last quarter to potentially fill this need. There's been obviously a lot of nervousness. There's been a lot of surprises. And throughout this, we want to talk about just some of the experiences that we've had, learning by doing, and learning in the current environment, and perhaps predictions, for the future in order to ensure that we can actually have a resilient collection strategy. So, just kind of want to then open up, to the panel. Just talking about some perhaps insights in how we can actually see that, what we need to do just in the current environment, and how to, just build a resilient collection strategy. For example, just dealing with multi-channel capability, what has sort of changed in the current environment, or that we need to kind of focus in, just in terms of building and maintaining an efficient collection strategy on that front. And maybe I'll just open it up to Brian, maybe to start off with that.
Yeah, thanks, James. First of all, thank you for moderating, and thanks for everybody for joining today. I'll start with a little bit of level setting, which is emphasizing something that everybody already knows, but which is that we're sort of in an environment that is completely unprecedented, not just in Canada, but sort of around the globe as far as what the economic conditions are. And if you took us back to the middle of March, in a time period where it just looked like the world was on fire, and getting worse during that period, there was a lot of fear that was going on as to what it was that the coming year was going to look like. And I'm sure everybody went through their own heart palpitations at that point in time. But within our business, we were kind of looking into the future and saying we had to completely throw out the book as to what it was that we thought we could forecast at that stage. We just didn't know what was going to happen. And as a result, we were taking some pretty draconian views as to what the recovery landscape was going to look like in Canada. Everything as far as, runs on the bank were being contemplated at that point in time. So, fast forward over the next 6 months, and it represented sort of a completely counterintuitive result from what you would have expected. You have massive unemployment spikes, you have GDP drops like crazy, but at the same time, delinquency rates have been down, loss rates have been down. I'm sure everybody's seeing it in their own portfolios, and in the recovery world, recovery rates have been up dramatically. So it turns out that injecting in $1/3 of $1 trillion into the economy does something, and it did quite a bit during that period of time. So it's been a lot of sort of learning as you're doing even within that recovery space. But if I was to sort of step back and say, well, where do we stand today? The general consensus is that there is a coming wave that everybody's going to experience, be it losses, delinquencies, but also impacts on recovery rates within the receivables management space. And when that comes is a little bit speculative. I mean, there's different views. I think other members of the panel, I'd be interested in their thoughts as well. But the general view is that at the end of this year, kind of beginning of next year, there will be that wave of delinquencies and defaults that are sort of coming into the space. So I would sort of say to your question, James, is what do you need to do to try and prepare for that? Well, there's a kind of a set of things that I think all lenders, whether they're small or large or specialty or monoline lenders or sort of multi-product lenders should be doing in order to try and prepare for that wave of activities. And we'll try and touch on some of those today. The first one, as you kind of mentioned there, is just on channel management. I think Amir can probably talk about this one pretty expertly as well. And that you need to kind of evaluate what it is, how your relationship with your customer has changed and what's changed in their life. Because for the longest time, you've been dealing with people in very low touch, low friction, somewhat passive means. You don't want to be constantly speaking with somebody every day or every week or every month even. You just want to make sure that you've got a frictionless payment structure in place. That relationship is different now. This person is no longer somebody who you are trying to build a relationship with that will, that you will be able to extend additional credit for. You're now trying to build a relationship with this person where you get top of pile as far as new payments are concerned. So as they've got sort of a fixed amount of capital that they can utilize to satisfy their obligations, your goal it should be to be the first person on that list. And that means having kind of multiple strategies and multiple channels that you can deal with that person on in order to try and communicate what it is that that their options are for repayment. And it's a firm message, but it's definitely a fair message as well. So I'd be interested in some other, that's sort of a long-winded answer, but interested in some other perspectives as well.
Yeah, well, is that okay with Nathan? James, I'll go add a few points there. I agree. I mean, federal aid was great. Collection went higher. But one thing is for sure, there's going to be a massive backlog of receivables that are going to be out there very soon, towards by the end of this winter. And to be able to collect on those, traditional channels won't work anymore. I mean, we recently conducted a survey right at the beginning of COVID at Lexop, where with over 3,000 Canadians, just to understand what they're expecting, what they're getting, what they want versus what they're getting. And the results were fascinating because people don't like to answer phone calls anymore. We don't answer phone calls anymore. We don't pay attention to letter mail that's sent at home. We just keep it and forget it. So now it's just one of the most important factors of collection is getting the person's attention, right? It's rule number one, get the person's attention. If that doesn't work, you'll never collect. And that's going through digital channels, whether it's email, whether it's SMS, the channel that converts, the better. And then the second thing about channel is it's about templating. What's the message you're sending? If you're sending the same message to everyone from 30 days to 90 days, we have a huge problem there because they don't engage with that template, with that wording, as well as other people. So, I mean, these are in terms of channels, digital contact methods is absolutely important. It's number one factor that came out. And then the second one is once you've caught their attention, what's next? You have to convert them, right? And especially during a season, a period where everybody's going to have a lot of past due accounts, past due receivables out there, you want to be able to offer them a flexible payment options. That's the number two reason that came out. And it's extremely important. And so rule number one, you put in some digital channels, and then number two, you convert them with flexibility. That is what we are focused on anyways at Lexop, is to offer technology that can automate that. Because at the end of the day, one other important thing is that you may have enough manpower to handle your current collection, the early delinquencies or a portion of those past due receivables, but you won't be able to to handle all the backlog. So automation will be key to helping or establishing a resilient collection strategy. And I'll stop there and we can get back to others.
Yeah, great comments, guys. And I'll kind of echo, I'll echo a lot of that. I mean, certainly echoing Brian's sentiment. I think everyone felt this with, I think your description, Brian, of COVID kind of, start to now is, I think a lot of boardrooms were having a lot of the similar conversations that sounds like you guys were having. And I think a lot of us have been at least pleasantly surprised in the short term that the results were a lot different than expected. Also agree with both of you guys that, the wave is coming. I think, we're all preparing for it. Yeah, we're no different for sure. My kind of high level comments, I think the way that I look at, how to build this resilient collection strategy is the things I'll mention are things that anyone should probably be doing anyway. But I think because there's a massive wave, it's going to force us, right? Like I can prescribe a bunch of stuff. And I think the things I'm going to mention probably apply to most businesses, right? It's more, for me, the strategy is more about, broader trends in a lot of different product lines. And then, an event like COVID, it forces us to sharpen our pencils and get to work on it. So the things that I see in the marketplace and we'll see everywhere. So, hyper personalization, right? A little bit to the point of channel management, but it's deeper than that, right? It's, again, similar to what Amir is saying, hit customers in the right channels with the right message that's hyper personalized to them, right? We're all used to it now. Every ad we see on the internet is hyper personalized to us. Everything that marketers are sending our way is hyper personalized, right? And so a lot of that it's about, I think historically the collection agency or the collections world has been a little bit like, you owe us money, so we're in the driver's seat, right? And I think consumers, millennials, the younger generation, they expect a different interaction. They expect everything hyper personalized. And again, I can say that to any business, not just collections. I think another thing is
the reason. I'm sorry. It's because collection has never done it. This collection has never done it.
Right.
A lot of other segments have done it. Collection has never done it.
Right. So it's a great opportunity, right? There's low hanging fruit there. I think the other thing that I see is we're in an instant gratification world, right? I think about payment experience, like when I first got a Visa card, I'd have to, if I went to a merchant, they'd print out a little slip and I'd have to sign it, right? Now I get annoyed if they don't have tap, right? So again, it's similar in the collection space, right? If you're trying to collect money from someone, you want to make it as easy as possible. Hit them, play in the space where they play. If they're used to making a payment online with PayPal, with the credit card, with Apple Pay, whatever it is, right? We're getting so impatient as consumers, and I think if with our collection strategies we can adapt to that same philosophy, reduce friction. I think the expectations are really high, and as Brian says, we want to be at the top of mind, at the top of their kind of payment stack. Well, if I've got 3 emails sitting there and one is a PDF form that I've got to print out, sign, and fill in my credit card number by hand, or if I've got one that's Apple Pay, which one I'm going to pay first, right? And obviously, maybe I'm speaking to a more tech comfortable generation, but there's more and more, in our pools. I think Brian, we were planning to get into this as well, but I think that the other thing is try to build a data-driven strategy, right? We're all sitting on hordes and hordes of data. And, we hear a lot of AI and machine learning, all these kind of buzzwords. Some of it sounds really scary, but to be quite honest, anytime I've looked under the hood of someone who's talking about an AI solution, it's really not actually as complicated as they make it sound. They want to make it sound really sexy to attract investors and attention, but really it's actually, so I guess my point on that is don't be intimidated, right? Don't be intimidated by trying to dive into your data. It's not as scary as it sounds. And there's lots of people that, that can help. But we're all sitting on a lot of data that can help us kind of get back to that hyper personalization or segmentation, right? Find ways, if you don't have internal expertise, find some third parties, find some outside resources, and really dive into your data and understand how you can, segment, personalize, hit people where they are. Like I said, I think all of these sort of tidbits, I think are stuff that, like I said, we should be applying anyway in any business, but collections is kind of ripe for it, ripe for disruption, ripe for kind of innovation. And I think the coming wave is going to force people to kind of innovate or fall behind.
Yeah, I'd emphasize as well, just to kind of echo what you're saying, Nathan, is that this group, the CLA members, should be a group and are a group that are more comfortable with data and know more about the customers than I think a big bank or sort of a big lender or sort of a legacy lender would. And although the big banks have a lot of information available to them, they surprisingly don't do a really effective job of deploying and utilizing that information within a recovery strategy. They do a really good job of using that information in a customer acquisition strategy and for fraud prevention, but they don't do as good of a job on the back end when something is sort of rolled into a non-customer category. So I would say that it's not only is the sort of the market ripe, but I think this group should have the tools and the expertise to be able to sort of capture that. It takes a little bit of elbow grease and it does require a focused effort, but it should be something that we're able to obtain.
Absolutely. I agree.
Something I think you kind of all touched on, sort of mirrors specifically, but you know, when we were talking about you know, flexible payment options or hyper personalization, but you know, just in terms of the changing environment and talking about automation, what kind of strategies or what can be done, if anything, when you know, sort of you're dealing with, you know, a bulk amount of, you know, possible, you know, collections, and you're talking about hyper personalization, but you know, when things are consistently changing, how can you consistently, you know, try to personalize when people's circumstances are so precarious, and you know, one day they might be able, you know, to pay, but then you know, it's next month to month things are continuously changing for them. Is there a way to personalize that? Is there options in order to deal with those types of situations? You know, presumably it's technology, but perhaps we can sort of talk about that, given that, you know, certainly we want to, you know, provide flexibility and personalization, but on the other hand, it can't be so granular that you're, you know, dealing with just one customer all the time and, you know, their particular situations.
Yeah, it sort of emphasized that the personalization is kind of and Nathan can probably speak more expertly than I, but it's sort of a form of really sophisticated segmentation where you try and understand what what kind of general box a customer might fit into, and what type of person that customer is, what point in their life cycle they are, what point in their credit cycle they are, what their propensities are to repay, what their capabilities are to repay. And trying to define that personalization, you can generally group people into certain areas to indicate, to say that this type of this customer block fits within a category within my overall portfolio that they're just not capable right now. They don't have the capacity in order to repay me at this time. They're unemployed, they have no assets, you know, they're living at home, they have nobody that they can rely on. There's nothing within that personalization that this person is going to be time well spent on your side to put resources behind trying to collect on that individual. But what that doesn't mean is that that person or that group of people are not somebody that you want to try and maintain a relationship with, because that situation will change. These boxes are not static, and people are dynamically moving around from them in their capacities over time. So if there is a group of people that you kind of deem to be low capacity, low propensity in your overall, you know, group of accounts, you don't want to actually spend time on those accounts. You might not even try and collect on those accounts at all, because you'll just be throwing good money after bad. But you do want to maintain a relationship with those people and try and maintain some sort of degree of sort of ongoing thread into them, so that way when their situation changes, either you can reach back into them or they can reach back into you. So don't look at these hyper personalizations as being fixed. They change constantly.
Yeah, absolutely. And I love that Brian said, keep the relationship. Absolutely. It's spot on. I mean, communication and segmentation is only the first part. That's step one. Once you've done that, even through technology, whether you're communicating via digital channels, there's certain KPIs that you can put in place so you can detect if, oh, this person is not engaging as they used to, or this person is not paying as they used to. So it's super easy to put in place. It doesn't take AI. I mean, you can just, I don't know, this person is not opening the emails or clicking on the pay button as fast as they used to, or they go on the pay button 6 times before actually paying. So there's certain trends that you can detect to see if, beyond the hyper personalization or beyond the segmentation, something is not going as planned. And these KPIs within your collection strategy will indicate that. They will divulge some information for you to act accordingly. So maintain that relationship, whether it's in person, ideally not. You want to make it as automated as possible. I'm talking because I'm a tech guy, but ideally you can put some KPIs in place so that there's some information that pops out when something is going wrong, or something is not being as regular as it used to be. Anyways, in my opinion.
So there was a question. Oh, sorry.
I'll touch on that question, maybe, James. I think because you know, I sort of started this hyper personalization comment. I'm just trying to, now I got to navigate Zoom to. James, do you have that question in front of you? Sorry, I had it up and it's, oh, there it is. Oh.
Yeah, it was a question just about hyper personalization versus privacy. Is there a line drawn in the context of collections?
And I think the way I think about it is probably more the way Brian and Amir were talking about it, where it's more about using the data you have to understand and respond to the behaviors that you're seeing, right? So understand your own, like segment your own portfolio and understand which segments want to hear from you at what time of day, how frequently, want to use what payment methods, right? Like, I don't think you're getting into any privacy concerns. You're using your own data to understand your portfolios and their behavior. And then I think Brian's right, it's probably more accurate to call it hyper segmentation and understanding each segment's behavior and each segment's preferences. And again, you can do that all with your own data, where it's not about digging deeper into the customer's kind of personal data.
And I guess I'm putting my previous life as a banking lawyer hat. You use privacy. You use the data that you need in order to offer the service that the customer needs. Beyond any other data, that's where you go into the gray zone, and you don't want to do that. You always need to use the data just to offer the service that the customer needs. And at the end of the day, within collections, segmentation is a service that the customer needs. So you used to, if you don't need to know their sex or their age in order to offer a good collection strategy, you might want to avoid that rule of thumb, but there are some gray zones. But in terms of data, you always want to use the strict minimum, let's say, in a good rule of thumb, in order to offer the best services possible. And that best service and that minimum are often like zones that you have to be very delicate with.
I think that's a good point, Amir. And generally there are certain aspects, of your data that you want to make sure you understand are more sensitive than others. Even if you are segmenting people down, you don't want to let the machine just sort of determine your behavior, because if you are breaking people down in a way that is based on their age or is based on a socioeconomic status, that ends up meaning that you treat different groups differently and offer maybe a different settlement option or a different resolution option to one group than another, then you can run into issues. But that's some of the art in making sure that your data is and your models are being effectively moderated, so that you don't just sort of let the machine run wild. But it's a good point.
Great. And so Clinton, like over at LM, do you guys do sort of segmentation as well, or do you guys have maybe a little bit of a different strategy, just in terms of just in terms of channels and what have you?
Yeah, definitely. I want to first thank the CLA for including us here in this panel. It's very interesting hearing what everyone else is saying, and I'll echo a lot of what they've said. I would only add that for us, a good collection strategy, while using data and data mining to make sure that we stay on top of things, also includes responsible lending, and especially with a possible looming second wave of COVID, and obviously the impending end of government help to the people that need it, and even the companies that need it, therefore employing people. We also wanted to add not just to the data mining and the tech aspect to it, though, a more empathetic look at our book and segment it in where we take certain demographics, and then from that do a focus group, if you will, and talk to people preemptively. Maybe when we gave them the loan at the beginning, there were indicators that they were probably in a higher risk category, and talk to them about what they're going through, what they're seeing happening in their own lives. And then from that, be able to glean from it, which we have strategies that are kind of proactive in the event there's a second wave, and for the obvious and eventful situation where when funding stops, that there'll be a lot of people dealing with what they've done in terms of deferrals and whatnot, and having to kind of reconcile that in their own homes. That being said, some of the data that we've received, not just from the actual what we have on file for them, but through conversation to a segment of the population, we've been able to establish programs that someone can opt into. And I know when you're dealing with massive quantity, it can be laborious, but where that labor is concerned will help us get more market share in the long run, especially through word of mouth.
So one of the questions I kind of did have as well, kind of went around just dealing and understanding, particularly within this time, is just trying to understand your economics clearly. Because right now, we mentioned there's been a huge influx of, government cash. We assume that there's going to be, a wave, and eventually there's going to be withdrawal of, some of that cash. So how do we kind of avoid throwing good money after bad, and what are some of the strategies that we can, employ? What are some of the things that we should actually, focus on? Is it, or do we just go for, the potentially large receivables, or, do we sort of focus again with those segmentations, certain segments where we think we can get more receivables initially, and then perhaps once things taper off and get a little bit better, we can, go against other receivables. So sort of what are some of the strategies to ensure that, just certainly in the medium term anyway, short, medium term, that we're using resources and our economics appropriately and efficiently?
Yeah, this is, sorry, go ahead.
Brian.
No, please, Glenn, go ahead.
I think that because these are uncertain times, that there has to be a certain amount of expenditure that's allocated to just kind of dealing with that exact type of thing. And it's something that we have to eat, knowing that within the next 12 to 18 months, that'll come back. Obviously, the business is out there to be had. And, kind of like the canary in the minefield right now, will be the way receivables are going to be affected should there be a second wave. And if there isn't, with the ending of the government stimulus, seeing how many people, and there are a lot of studies out there that are staying on top of that hardcore, of how people will actually be impacted by that, and then we'll be able to scale up going forward. But there has to be some understanding that there's going to be some money spent, and it'll be more than not in terms of keeping your some of your receivables anyways, and a more customer service based type of scenario instead of going third party.
Yeah, I mean, it is a challenging time to understand what segments are going to behave in what way, because as Clinton says, the government stimulus programs have just sort of, poked the machine, and now the machine is acting in ways that it never has before. But there's sort of two elements that I would sort of highlight as far as understanding your economics. And that's really just getting really clear down to what your unit costs are on a lot of these fronts. And there's two pieces that make that tricky. One is, you get sort of emotionally attached to the loan that you've given out. And if you've given out a $10,000 loan, you then go to that person and try and collect a $10,000 loan, that number is gone. That person is in a different situation than when the loan was originated. Could have been a health incident, could have been a job loss, could have been macroeconomic factors. But all that number represents is the ceiling of the number that you are possibly able to recover from that person. It does not represent that is the number that you have to be going after that individual for, because that person's capacity and propensity to be able to repay you has changed dramatically over that period of time. So you almost have to re-adjudicate that individual to say, how much credit is this person worth given their current situation? And would I take this amount of credit in replacement for the $10,000 account or the $20,000 account that I previously had? And that can be a difficult emotional point to make, in that you still get attached to the $10,000 account, and you may want to hang around the hoop and say, you know what, I'm not going to take a lower amount, but as we sort of said earlier, just maintain a relationship, because we think in the future the person will have capacity or will have the desire to repay me. So that's sort of item one. The second item is about understanding your cost structure much more clearly than you previously have. So you don't want to spend $3,000 chasing an account that is only $2,500 in balance, right? I mean, that's just kind of obvious, but you've got to really understand how these costs that you incur compare against the benefits that you're getting on them. And if you're spending an inordinate amount of money to try and track down low balance accounts or even mid balance accounts, then you probably could be taking those dollars and redeploying them into originations and making a better return on equity in that side of your business. So it is something you really need to understand your unit economics and your opportunity costs much more clearly.
I agree. I mean, we're aligned on a lot of things that Clinton and Brian said. In my opinion, in terms of treating how you attack your receivables, I personally believe that not everybody is an absolute delinquent as soon as they're late on a receivable. I think one strategy can be to focus on the low-hanging fruit. Early delinquency can be salvaged through automation. Again, I come back to that. I think automation can help attack a lot of those receivables that can be self-cured. And you can allow your team, your collection agents, to actually focus on the more complex accounts, the ones that actually need human intervention. Those can have their own treatment cycle. Those can have their own strategy. But there's a portion of it where you can automate and collect from using automation, using software, and that will allow you to basically kind of hone down on what are we actually focusing on, because a lot of it is being handled on the background. That's one thing. And I noticed a very interesting question that I think Kevin is put there. James, is that okay if I answer it, or give an opinion on it? Is that okay? I can't hear you.
Yeah, go ahead. I was going to go into, but if it,
I'm allowing
what
myself.
You're saying, please go ahead.
Oh, sorry. Yeah, and it's we notice is how effective is having multiple payment methods. Do you see that? There's a substantial decrease for defaults. We noticed that adding credit card, bank transfer, even PayPal, it absolutely increases payment methods, because don't forget, quite often maybe one account doesn't have money, but your payroll is now deposited into another account. You didn't have time to transfer that account or that payment method. Just being able to do it and select different accounts on your own, on your mobile, is absolutely tremendous, and it really increases your collection rates. And the other one, how effective is communication via social media? Again, I'm putting my previous lawyer hat. Usually when a loan is given to a consumer, you have a clause in there that says you allow us to communicate with you via the method that you have provided. If one of those methods is social media, I guess it's okay, but it's very, very rare that you give your Twitter handle or your Facebook handle to it. And in terms of commercial loans, you always have section 13 is always there right before miscellaneous, that says notices can be sent to this email address or this email address for the borrower or the creditor. So I mean, unless it's actually allowed, I don't think you can send communication via social media. That opens Pandora's box.
Yeah, I would echo that point. Is that going on there are some precedents, not in Canada, but in Europe and some in the US, of companies trying to use social media as a means in order to collect, and it's sort of the equivalent to sort of driving up to somebody's house and then putting a stake in their lawn that says this person owes money, and it really is not received well by government regulators, rightfully so. So I would highly caution against using social media as a channel, but having multiple payment channels is certainly useful. Again, a point of caution is anytime you add multiple payment channels, you will cannibalize some of your previous payment channels, which might be fine. I mean, ultimately, the objective is to remove friction from the customer's payment process cycle. But if you're sort of bringing in a payment processing system, for example, like I'll use Square as an example, though it's not one that you need to be physically there, but has a very high sort of transaction cost. If you're cannibalizing some people from another payment cycle, which is a lower cost transaction, over to a higher cost transaction channel, you're just upping your costs and not really increasing your recoveries. There might be some offsetting effect there, but just make sure you understand that it's not about having 1,000 different payment cycles. It's about having 5 really good payment channels.
Just to pick up on that a little bit too, go a little deeper on that. I mean, I think as we're all trying to roll out new strategies and come up with, ways to be more resilient, don't be shy to start slow, right? Like if you're rolling out a new payment tool, roll it out to a very small segment, right? Test everything first, be scientific about it, understand if it is having the desired impact or not having the desired impact, right? Like don't panic and roll something out new to entire portfolio without seeing if it's worked or not, right? Give everything a chance in a small test environment and measure those results to make sure that you're actually getting what you want.
Absolutely.
I guess sort of to that point, so starting slow, is there any, you know, reimagining different types of partnerships, for example, that, you know, we could exploit just in terms of more efficient strategies going forward, just to ensure that, you know, the old adage, together we're stronger type thing. Is that in any of your guys' mindsets, you know, at this time?
I'm planning to partner with everyone in this channel right now. So.
There you go.
Well, and I think the point that I would sort of make, and this is obviously sort of, you know, self-serving, is I think all of our businesses are built on the idea of partnering with each other, because in sort of an individual basis, no company, you know, within the CLA makes up a significant conglomerate, an absolute behemoth organization like a bank that has all of these verticals and can build out all of the components and build out their product teams and their tech teams, and they have 20 people on a single channel and all those pieces. That will never be the path for a small business, and it shouldn't be. It's not the most effective way to grow our businesses as a whole, because the opportunity costs and the resources and the time to deployment are just way too high. So I encourage all companies within the CLA to look into the network that this is, because individually we represent a vast array of very deep experts, and frankly, I think better experts than exist in a lot of more larger conglomerates. So collectively, you do have quite an expansive suite of capabilities. There's some things that you want to internalize, and there's some things that you want to externalize, but I think partnerships are the much more effective way to deploy and test and decrease the risks that something will not sort of be effectively launched. So yes, is the quicker answer to utilize partnerships wherever you can.
You know, in this age of uncertainty, especially as it relates to what may happen in the fall in regards to stimulus, as well as a possible second wave, I echo Brian's sentiments, where I'm looking forward to being able to you know, lobby government, federal and provincial, for leverage that will allow for less red tape, and in certain instances when it comes to lending, and for sure in terms of collections, while being responsible and having you know, a kind of pulse on what's happening with the Canadian public, still be able to be effective at it. You know, because I'll say that some of the people that we've heard from when it comes to collections, from what they hear in the media, whether they have a clear understanding or not, it's kind of like, I don't have to pay. You know, and they're smug about it in the sense that, hey, you know, don't you know it's COVID? You know what I mean? And I'm thinking to myself, you know, you have to be wise. I don't want to say something to them that's going to, you know, make them feel like they have no understanding. But the truth of the matter is that, you know, with deferrals and taking advantage of these types of things, whether it's with us or with a big bank, the chickens will at one time come home to roost, you know, and we'll be there still. So I think the CLA being this conduit to be able to lobby government and kind of help shepherd some of the people that are going to be hurt with these pain points is wise. So a lot of the projecting that we can do, and a lot of the planning that we can do, squarely lands in the understanding that our relationship all converge with this CLA type of middle ground.
Yeah, what Clinton said.
Keep muting myself there. So we're at 10, well, we got about 14 more minutes left. So I just want to encourage anybody, if they've had questions, we were, like I said, going to leave the last 50 minutes for questions to the end, but again, we're all obviously wanting to encourage people to ask questions throughout, but just given that we're sort of nearing the end, if you do have any questions, do encourage you just to go in the Q&A box, type them in, and our panelists will certainly be happy to entertain those. So I guess maybe just moving on to the next topic is just in regards to the government stimulus programs and the withdrawal of that. And what do you think is going to be the biggest factor and biggest risk to our respective firms or businesses as those government payments sort of do come to a halt? Obviously, when we're dealing with bankruptcies, there's a process there that's sort of out of our hands. But how is it that we can best sort of manage that as the inevitable government funding does come to a halt?
Yeah, so I think as that government program is going to come to a halt, there's going to be sort of some specific consumer effects. Naturally, for those people who are on CERB programs who are not able to transition to EI, they'll find a pretty material drop in their top line income that they've got available to them. And sort of concurrently to that, although not a lot of people are sort of noticing as well, OSFI right now is changing the regulations around how it recognizes mortgage deferrals, which is going to make it much more difficult for the banks in order to continue their mortgage deferral programs, and they're going to start pushing to get those payments back up to good standing. So as a result of that, you're going to see a very material top line drop in people's income and a pretty material increase in people's non-discretionary spending. So those items are going to create quite a bit of squeeze and a crunch on free cash flow available for debt retirement or savings. And as much as people have been satisfying their debts during this period of time, that will affect recovery rates, and it will affect delinquency rates as people can't satisfy minimum payments on their debts. So that is what will happen in the fall, right? The question then is, how do you sort of prepare, for that exercise, and what can you do in order to try and establish it? I think that's kind of what we've been trying to talk about today, about establishing those relationships early and get those sort of pieces in place. Ultimately for those consumers though, they're gonna stop paying, and I think people need to establish as we've said from the beginning, a relationship now in order to maintain some degree of consistency on a sort of a post stimulus basis. Now, the other open question here is whether or not there will be a second round of stimulus programs that are being put in place. I think one thing I've learned through this exercise is don't fight the Fed in Canadian version of it. So don't fight the BOC, if you want to call it that. So wait and see whether or not there is another program that is run out. But if that does happen, then we'll find this will just keep pushing these items out farther and farther. Specific as it relates to insolvencies. Insolvencies, as you mentioned, James, those are a difficult one in order to prevent the actual event from occurring, because by the time you receive an insolvency notice, the consumer has already walked into a trustee's office, they filled out an insolvency form, they've gone through the financial disclosures, and they've submitted the file. They've already jumped the sort of emotional shark, if you will, and they're filing that process. So there's very little mitigation you can do to the event itself. What you can do is evaluate the insolvencies that are coming through. They're not written in stone that the information that is presented is the information that you must accept. There are, challenge options. There are sort of different tactics you can take with the trustees in order to try and increase the quality of the insolvency that is coming. Those have very strict guidelines around them, and we could spend a whole session on that as well. But don't ignore that part of your book, because it does require some attention as well.
I think that part of this too is keeping an eye on what's going to happen politically. I mean, if Erin O'Toole triggers an election after Trudeau's throne speech, and depending what happens after that, if we're in a situation with a majority Liberal government, federal Liberal government, or a majority or minority new, more right-leaning federal government, then we can rest assured that how the potential stimulus package, if there is a second wave, is rolled out, would definitely affect what we can do. But paying attention to it on that level also gives us an opportunity to be ready again in the event that there isn't. And I mean, Canada's doing very well. We obviously should be doing better, like lower numbers in terms of cases of people getting COVID, but it's still pretty low. And I think that if there isn't a second wave, we know for a fact that they're not going to want to put out money. Instead, it'll be more of an aggressive way to lower deficit. And with that being the case, fiscal responsibility would be the message. And as long as that message is being communicated, whether it's through tech in what we do, AI or otherwise, that's how we can make sure to mitigate what could become out of hand collections. But at the end of the day, there should be a lot more business coming in, and hopefully that it helps on that end too, in terms of acquisition.
We just have a question here from Eric. Options, benefits / drawbacks of third-party / external collections or credit counseling for first notice and or unresponsive clients. Could extending an offer for assistance be more effective?
I'm
I have
not
an
sure
opinion, but
yeah.
I'll turn it over to others. Yeah, I always have an opinion. You know, and somebody else feel free to jump in. I think there's different kind of categories that you've kind of broken out there. If I understand the question, it's what for very early stage delinquency, should I be internalizing that activity, or should I be partnering with a third-party collection agency or a credit counselor in order to send a notice from a third party? Will that generate a better response than it would if I just send another notice from the company that I already have? I think to some degree that depends on the hyper-personalization that we kind of talked to at the beginning. It depends on the customer, and that if you already have a positive relationship with that customer, then you should be able to generate a better response than a third-party agency being kind of dropped in front of them. I'd also caution that a third-party agency can sometimes create a little bit of a defensive posture from a consumer's perspective, in that they suddenly feel like they can't call out and reach out to you because they're being reached out by a collection agency. It's not always the case, but sometimes it can have that sort of effect with people. So you've got to be a little bit cautious. And it can be a little bit expensive, but it is a effective means in order to induce an activity from a consumer who you haven't been able to develop an effective relationship with, or who is already in a defensive posture. You know, you're better to kind of push that relationship and let them be the bad guy than it is to let you be the bad guy. So it kind of depends on that. As it relates to the credit counseling industry, it is important to break the credit counseling industry into its kind of constituent pieces. There are for-profit credit counselors and there are non-for-profit credit counselors. The non-for-profit credit counselors are a softer approach to the consumer, and they don't cost the consumer as much money. They cost the creditor money, but it is a more sort of accepted version, I would say, of credit counseling for the consumer space. The for-profit credit counselors will actually charge the consumer money, and I don't want to sort of paint them all with a single brush, but they sort of to help the consumer dodge their debts. So it's a different type of process than it is somebody who's actually helping them resolve their debts. And I would say make sure that if you're going down that path, even if it is a for-profit, make sure it's the right type of for-profit, and it's not just kicking off a relationship to another party whose primary job is going to be to wrestle that relationship from you.
Yeah, and and what we see with our clients is that if in early delinquency you want to go to a third party, what that does is, one, yes, absolutely, like Brian said, it's expensive, but we also noticed that it kind of we work with telcos, we work with utilities, we work with banks, and they told us, listen, we want to avoid going to collection. Is third party is good. I'm not bashing anyone, but I'm just saying we want to avoid going to collections at the beginning, because we noticed as soon as you go to collections, it kind of breaks that relationship between us and the customer. And what it also does is that third party doesn't necessarily have your brand at heart in terms of that's our value proposition. They're working with multiple brands, so it may have an effect on your brand because the strategies may be a little bit more tough, and rightfully so. But just in terms of early collection, that's why one of the we've noticed these days, and now especially with all these social media out there, as soon as you see a bad review, it can affect the whole pie. So you want to be as flexible and keep it as internal as possible. because it can break the relationship if you go to third party a bit too soon. What we've noticed the past, I don't know, 50 years, 60, 70 years, collection has always been a little bit on the rigid side, and nowadays flexibility is key. You need to keep that as internal as possible, and we've seen the results are better when you try internally to handle that situation with the customer. And then ultimately, if it doesn't work, we're like, you've tried your different scenarios, and then you can give it out to third party. Anyways, in our experience, we've noticed that internalizing it as much as possible at the early stage makes a difference. Because brands right now, like big brands, Rogers, they're very worried that their brand may be affected, right? It's just very important to keep that perfect reputation. And very often has happened, we have data to show it. I mean, we're not going to hide ourselves. It's that when it went to collection agency, it became a little bit rough. So that's the thing. But it's all changing. It's all improving. Anyways, that was my comment regarding early collections, early delinquency.
Great. We have maybe time for one more question. So I'll just wait if anybody has one. But I guess in the meantime, I'm going to hand it back to Tal here. But I just want to thank the panel for sharing your insights and with us, and your tips and how to build and maintain a resilient collections practice, particularly within these times of uncertainty. But one of the things that I got out of it though as well, especially we were talking about at the beginning, certain strategies that can be employed, or I guess kind of things that we should be doing anyway. And if we're constantly doing those, looking back at what's effective and what's not effective, that'll certainly help us, in the future, because things are always dynamic and changing. I guess this is just more of one of a degree. So yes, I just want to thank Amir, Nathan, Brian, and Vinton for joining us today, and having this opportunity to also to moderate. And it was all great meeting you virtually as well. And thank you to everybody who participated and throughout the country. And I'll just hand it back to Tal here.
Thanks so much, James. And thank you everyone for a really interesting discussion. Like I mentioned at the beginning, we're going to be circulating the recording to everyone that registered. So don't worry if you missed a little bit of it. We'd love to have you back. We're running these webinars on different topics in lending and fintech almost every month. So if you want to participate, if you have a topic that you'd really like us to cover, or if you just want to be more involved in the Canadian Lenders Association, please reach out to myself or follow us on LinkedIn. Again, thank you so much to Lexop for sponsoring this webinar. And we'll be sharing Lexop's contact information as well when we share the recording with everyone. So a final thank you, everyone, so much for joining us across the country. And we'll see you all very, very soon.
Thank you. Appreciate it.
Thank you.
Thanks, guys.